Good afternoon, ladies and gentlemen. Oh, of course, I say good afternoon to those of you joining me here on the East Coast. It is just after 12 noon Eastern Time. Of course, I say good morning to those of you in the Central Time Zones, Mountain Time Zones, and Pacific Time Zones. And, of course, good afternoon or good evening for any of you joining us from across the pond in parts of UK or parts of Europe or maybe even parts of Australia. Today we're going to discuss the radioactive trading initial setup structure, the best put to ensure your stock positions to not only control risk, but of course have that second asset in place that later on can be manipulated to lower the risk on the position. For those of you who don't know me, my name is Mike Chupka. I'm the Director of Education at RadioActive Trading and at PowerOptions. Now, many of you are familiar with the basic concepts of the radioactive trading techniques. The initial starting point, how we open any trade, is we're going to open a stock and put position that guarantees you can't lose more than 4 to 8% of your investment into the position. As that position is now in place, we'll then apply the 12 different adjustments, which we call income methods described in the blueprint, to further reduce the risk, generate income, and eventually bulletproof the position. That means when we've taken all the risk out of the trade, have a no-risk trade that still has infinite upside. Now, why do we trade this way personally? Myself, Ernie, other staff members here at PowerOptions, numerous radioactive traders and blueprint owners, well, the obvious answer is insurance. To protect our investment, to protect against the lie of leverage, which might have hurt many of you before with different things such as credit spreads or even just buying calls and accidentally putting too much money into a speculative long call or even buying a put position. The flexibility. We don't just place the trade, the initial married put structure, and hope that the stock's going to move up and we're going to meet our goals. That would be great if it happened, and we're in a position to let that happen. But the 12 different income methods allow us to adjust the position, lower the risk, and increase profits, whether the stock is stagnating, if it's moving up in price, or if it's moving down in price. It's low risk and low stress. I don't have to worry about any black swan event. I don't have to worry about any CEO of a company I invested in suddenly going off the rails and posting things on Twitter or doing any kind of outlandish things on interviews, anything of that nature. I've controlled the position better than a stop order. A stop order is assumed insurance. This structure is a guaranteed limited risk. Low stress. It's not like trading a weekly credit spread where you're just maybe 1 or 2% out of the money trying to get a 20-cent profit on maybe a 5-point spread or a 2-point spread where you're worried about every 30-cent, 40-cent change in the stock price and seeing your options maybe double where you're worried that now you have to adjust the position. I can relax, sit back, let the position move up, let the position move down, adjust as necessary. Now, I entered this last bullet point here. It was about a month and a half ago, 2 months ago, during one of our Friday open discussion sessions, a customer asked if you could only trade one strategy in your portfolio, what would it be? And my answer was the radioactive trading techniques. So the reason why is that if you're telling me that I can only trade one position, if I can only trade one strategy with multiple positions in my portfolio, that means somehow I'm incapacitated. I'm not able to enter new trades. I'm not able to do other new entries. So what would I want in place? I'd want something that can take advantage of the market movement upwards, but still have controlled risk and avoiding the lie of leverage. Better than a standard collar trade which caps the gains to the upside. Now, let's get to it. The starting point. Every radioactive trade begins with a stock and put combination. We're going to buy shares of stock, but we're going to buy a put option. This is nothing new. It's a married put. But the basic, commonly taught approach at your broker, if you do a web search for married puts and you come across a free article in Investopedia or something along those lines, they always tell you to buy 1 month out, 2 weeks out, and buy a put option that is below the current stock price, that's out of the money, for a cheap price, 30 cents, 40 cents, 50 cents. But that structure is flawed for multiple reasons. It's not bad to want to pay less for insurance, but with any other kind of insurance or anything else, you get what you pay for. If I'm entering a stock position where you currently own a stock that you've had for a while at a lower cost basis, you're staying in it because you're expecting the stock to move up over time. Well, why wouldn't you want to pay less to have a lower cost basis? So the other day on Tuesday, on October 2nd, I could have bought shares of Penn International Gaming at $33. I could have bought the 19th of October expiration, 19 days out, cheap 30 strike put for 35 cents. So my total invested per share is $33.35. But the risk doesn't kick in until the stock hits 30. It's got to drop 3 points before that insurance starts helping the position and I start getting something back. If it does drop below 30 and I take the maximum risk, it's at 335 or 10%. This is a Married put. It's a cheap cost. It gives us unlimited upside. You do have a control risk. You can't lose more than that 10%, but that is on the high side. And the insurance is only for 19 days. What happens at the end of that term? All right. Why is a 10% risk high? Why am I calling that high? Many of you may use stops on your stocks, or even if you're trading an out-of-the-money credit spread or an out-of-the-money naked put position, you might set a stop on your stock if it falls 7% or 8% or so. Once you start getting into the double digits, the lie of leverage really starts to hurt you. It's referred to as the Martingale. If I take a 10% loss on a position, I don't need a 10% gain of what I have left to get back to break even. I need an 11.1% gain. If I take a 13% loss, I need a 15% gain to get back to break even. And then it starts getting really dangerous. Many of us have probably taken a 25 or 33% loss on a leveraged spread. But that means that what I have left, if I take a 25% loss, I need to make 33% of what's remaining to get back to where I was. Some of you have probably traded stocks around earnings. Maybe you didn't protect it. Maybe you had a stop order. The earnings were terrible, and you saw a 33% decline in the after hours where your stop is violated, and you're just closed to the 33 or 35% loss. You now need a 50% gain of what you have remaining to get back to break even. Think about it. I put $10,000 into a stock. Poor earnings came out. It drops 33%. I get closed. I'm at about $7,700. I need $3,300 just to get back to the $10,000. So that's almost a 50% gain on what's remaining. And of course, if we take a 50% loss, I need a 100% gain. But I don't just divide by 10, meaning that if I only take a 5% loss, guarantee that on any position I can't lose more than 4, 5, or 6%, even if I do take that 5% loss, I only need a 5.3% gain to get back to break even. So I'm putting the market odds in my favor by controlling the risk. Now think about this again. Why would I not want to buy a 19-day out, even a 45-day out October put or a November put to insure my stock? Well, think about the time decay curve. We talked about this in the recent webinar we posted related to the radioactive trading techniques. The time decay of an option is most rapid in the last 30 days to expiration. You start to see it really fade off quickly. But if I buy a leap option, or I buy something that is further out in time, 5 months or 6 months out in time, even 4 months, the time decay over the first 30 days is very slow. I don't see the rapid time decay here that I'd get 19 days out, 20 days out, or 30 days out in time. So buying a further output is going to help me fight time decay. And if I'm buying shorter term, even if the stock's stagnating, I'm watching any value I put into those near-term puts just drop to zero. It's not really helping me as an investment or as insurance in that case. Now this time decay curve, it's the standard really for all option strategies. The application, the thought behind the time decay curve applies to anything. If you're selling credit spreads, for example, are you selling credit spreads that expire 6 months out in time or out to January of 2020? No, you're likely selling a weekly, 2 weeks out, 20 days out in time, maybe 30 days out in time, but no more. To maximize annual premium, naked put selling, covered calls, credit spreads, things of that nature, you maximize the annual return if you're selling shorter term, month by month, week by week. But when you're buying, even if you're buying an option as part of a diagonal calendar spread, or poor man's covered call as it's sometimes referred to, or even buying a call option speculating on a stock moving up or moving down, you're not buying 5 days out in time, you're not buying 10 days, you're buying 50, 2 months out, 3 months out, 4 months in time to allow the stock to move in your direction, give it more time, and also because you're paying less per day. Yes, you're paying more up front, but you're paying less per day because the option that is 6 months out in time is not 6 times the cost. All right, let's take a breakdown here. On October 2nd, the put options for PENN for PEN, on the 19th October expiration, the stock at $33 per share. We saw that 30 strike out of the money was at 35 cents. The 33 was at 95 cents, the at the money, and the 35 strike was $2.35. So there's only 35 cents of time premium in the money and the out of the money. 35 is $2 of intrinsic value. At the money is at 95 cents. But look at April. The 30 strike for April, which is 198 days out in time, is only $1.95. Okay, it is roughly 6 times the cost. But look at the 33 strike. At the money 95, the 33 strike on October 2nd for the April expiration is only $2.95. It's only about 3 times the cost. And the 35 strike, slightly in the money with the stock at 33, is less than double for almost 10 times the amount of time. It's about 19 days, 17 days versus 198 days out in time. But are the options 10 times the cost? No. When we look at April versus October, April's 6 more months out in time than October expiration. But as the exception of the out of the money 30, the other options are not 6 times the cost. We get a lower price per day for insurance by buying further out in time. But let's think of the structure itself. The trading plan. Are you only planning on being in a stock you just purchased for 19 days? What happens in October if the stock goes up to $36? Well, your put goes to 0. Okay, so maybe you only paid 35 cents for the out-of-the-money option. You still have $3 in gain in the stock. And if you paid 95 cents for that 33 at-the-money strike put for October expiration, well, you lose that 95 cents. If you've met your goals, you might close the position, liquidate the stock, and you're out of it. But if not, now you've got to buy another put. So come October expiration, your October put expires, whether you paid 35 cents or 95 cents for the position. But now you've got to buy a November, maybe another $1 or another $2, depending on how you're doing that. November expiration, the stock's up another point, put expires, now you've got to buy a December. You're already close to that $1.95, $2.35, $4 that you would have paid just by buying April already and still having 4 months to expiration of insurance in place without increasing the cost. Now, another interesting thing when we look at those different strikes, and we talked about this just a moment ago, the at-the-money options, 33 strike. The April has $2.95 of time value. The October has 95 cents of time value. The out-of-the-money option, the 30-strike put, and the in-the-money option only have 35 cents of time premium. Here we have $1.95 a time premium for that 30-strike, and here we only have $2.20. This is the at-the-money bell curve. When you look at any options chain, the highest time value is always at the strike closest to the stock price. It lowers as you go in or out of the money. What does that mean? Do I want to be buying into an option that at the time has the highest time value? Because remember, when I'm buying, I'm fighting time decay, regardless if I go 1 month out, 19 days out, or 198 days out in time. So I don't want to be buying at the money. I want to be selling. I want to be selling premium with the highest time value, not buying it. So, sorry folks, so there we take a look here. Any chain, you can pick up any chain after the webinar. If you've got another screen here and you're just looking at a chain for, say, Apple or something along those lines, you look right at the money. You've got the highest time premium. The lowest time premium occurs if you're in the money with calls or out of the money with puts. Of course, out of the money with calls or in the money with puts. So with that in mind, where does that push me to? Well, when I'm buying, again, an option for a calendar spread, or buying just a call or a put, or I'm buying a put to ensure my position, I want to buy protection farther out in time for the lowest rate of time decay at the beginning. I want to buy out or in the money for the lower time value cost. I don't want to be buying at the money. But we already saw how out of the money options, even though they're cheap, even far out in time, does not give us the proper insurance. The insurance policy does not kick in until the stock already drops 8, 9, or 10%. So when I'm creating this proper structure to control risk to 4 to 8%, I want to go to that 5-6 month range out in time. I want to be buying slightly in the money. But there is such a thing as too deep in the money. Here's a screenshot from PowerOptions of the prices of pen at the close of October 2nd. The stock's right about where it is now. On October 3rd, the pen went up to about 34.50, 34.60, and then it dropped again today, and it's around 33.40 or so. But we can see here that even that 30 strike out of the money put is cheap. This is $1.80. Remember, we saw $1.95 and it was at 33, but it's at about $1.80 at the close, but that risk is still 15.2%. The stock has to fall almost 10% before the insurance kicks in, and then I'm still spending a pretty decent amount of money because of the time. Okay, so this is not where I want to be. If I suffer a 15% loss, as we saw, I'm probably going to need somewhere around a 25% gain on my next trade to get back to break even. But as I mentioned, there is such a thing as too little risk. I can go deeper in the money, the 40 strike, the 39, and control risk to just about 2% or 3%. Well, the stock's at 33. I need the stock to move up to $37, $38, $39 before I'm probably getting close to my goals for a profit. I've seen positions where I could buy a stock at 50 and there is a 100 put strike available. And even for 5 months of insurance, I could buy the 100 strike put on my $50 stock for $50.35. I got $100 invested, I'm only risking 35 cents. It's a 0.35% risk. But what I'm essentially saying at that point is that I'm expecting the stock to double in the next couple of months. Honestly, if I have that extreme expectation, I'm probably doing something a little bit more speculative and just putting money into buying calls and not worrying about paying that much money per contract or that much money per share. But we don't normally have that. That's not a reasonable expectation for the stock moving forward. So there is such a thing as too deep in the money. Taking on too little risk hedges you out of the position to where you need an extreme gain in order to realize any reasonable profits on the position. And this is where we kind of come to the three bears of selecting the proper put for insurance. I don't want to buy at the money. It has the highest time value. I don't want to go out of the money because the stock has to fall before the insurance kicks in. Too deep in the money hedges me out of the trade and is not a reasonable expectation. So I want to control my risk, as we mentioned in the beginning, between 4 to 8%. And where is that? Somewhere within 1, 2, or 3 strikes in the money for a proper controlled risk. So here we see the 36th of April with a price of about 460. Total invested if I got in at 33.59, bought that put for 460, would be 38.19. I am guaranteed to get 36 back, so the true risk is only $2.19 or 5.7%. That is a good controlled risk. At the close, the April 35 is priced around $4. So my total investment would be $37.59. $2.59 at risk, or 6.9%. That's within my range of 4 to 8%. And also, of course, we look at the April 34. This one's just slightly in the money with the stock moving up. But here we're at 350, so the max risk is 309 or 8.3%. So we have the 3 bears here. This one's good, but it's just a little bit outside of the range. This one's okay. It's within the range, but I'm expecting maybe the stock to move up to 36 before it makes sense to do an adjustment or get a reasonable return. So just right is usually right in the middle. 35 strike, about a 7% risk, right in the middle almost of that range of 4 to 8%. There's nothing wrong with the 36. It is a reasonable radioactive married put trade. But when I'm comparing the 3 most likely candidates that are within my range, I'll typically go with the middle one. Stock only needs to move up to maybe 34 or 34.50 before it makes sense to do an income method and start counting down that risk. 36 gives me a lower risk, but I need to wait a little bit longer for the stock to move above 35 or 35.50 before I'd find a reasonable trade to start making adjustments on the position. So 1 or 2 strikes in the money, controlled risk between 4 to 8%, that is the proper structure. Now, of course, during the trading day, I've shown you some examples of where the puts were when the stock was at 33. So what was selected? Well, in my personal account and posted to the Fusion subscribers at RadioActive Trading, on October 2nd, bought shares of Penn at $33. Did buy that April 35 put for $420. So the total investment is $37.20. Remember, no matter what happens, going forward, my guaranteed return is $35. My guaranteed exit, it's a worst case scenario. The very worst case scenario, if I did nothing, made no adjustments between now and April expiration, I let the stock stay where it is or it falls a little bit more, it stays below 35, this risk on this position of 220 or 5.9% of my entry prices is the absolute worst case scenario. Why is that? The put doesn't go to 0 when I open the position. Just because I bought it doesn't mean it loses all value. The minute I bought that put at 420, I could have turned around and sold it for maybe 415 or 410. All I'm risking when I open the position is the bid-ask spread of that put. Over here, we see the profit and loss chart from PowerOptions. And the absolute worst case scenario, a little hockey stick graph here on expiration, is that if I do nothing, do no adjustments, take in no premium, I let the stock stay below 35, and I hold it all the way to April expiration, that is the only time I could realize that maximum risk. Now, of course, if the stock did something drastic and it lost 50% of its value tomorrow for an unexpected event, was trading around $17, I'm probably close to that maximum risk too. I'm not expecting that to happen. Did my research and analysis to make sure there was nothing out there that I know of right now that could cause the stock to drop 50%. Of course it could. But what am I going to lose? At worst, 5.9%. This curved red line here shows you the profit and loss chart at the halfway point. Yes, I have 37.20 into the position. So Jonah sent in a question here. Says, well, you're not going to make a dime until the stock goes to 37.20. And that's correct, Jonah. If and only if I hold the position all the way to April expiration and make no adjustments. January 11th, 2019, the halfway point between today and April expiration, even if the stock's trading right at 35, I'm going to be about at break even because the put still has 4 months of time value in it. That didn't disappear on me. That 220 is the time value. That is my true risk on the position, but it doesn't just go to zero. I'm in a position where I've got a controlled risk under 6%, potential unlimited upside profit as well. I've got time on my side. I'm going to have a very slow time decay because I bought the proper option, not the near term. If I did stay in this position to January expiration, and I had bought that October 33 put, well, the stock stays where it is. In October, I lose that 95 cents. I got to stay in it, so I buy in November, pay another $1. About $2 into the position now, or $1.95. The stock moves up as I expected. My November expires, and I buy a December. Let's say I buy a 34. Now that the stock moves up, I pay another 95 cents. I've got, roughly $2 and $3. I'm sorry, and 80 cents in the position for 3 months. I've got 6 months of protection at 420. I'm in a much better position because I followed the proper structure and didn't follow the basic flawed approach of buying a cheap, out of the money, 1 month out put option, which doesn't put time on my side, and I'm probably going to lose the entire investment in that insurance policy. The unique setup, buying that far out put, 1 or 2 strikes in that money to control it to that 4.4 to 8% risk, puts time on our side. Buying the short-term cheaper put costs less. Buying farther out and out of the money costs less, but puts you into that double-digit risk and almost accelerates that martingale or that live leverage. Buying further out in time, we avoid the rapid time decay. If I decide to get out of it in 3 months, let's say the stock does not move. Let's say for 2 months, 2.5 months, the stock stays right at 33 or 33.50. I'm going to have time decay in my far out put, but it's not going to be much. It's going to be much slower. Going slightly in the money means we take that ATM bell curve on our side. We pay less time value into the position than buying at the money. So the at the money bell curve, the red line, and forcing an ideal size trade with a proper structure are the 3 core components of radioactive trading. And if you think about it, they're the 3 core components of any options trade. When you're selling, you want to be selling closer in, and if reasonable, closer to the money to get the better premium. But when we're buying, we want to be buying further out in time. We want to be buying in the money to control risk properly in this case, and at the same time, paying less into the time premium. You don't want to go to those 10 or 15% risk by buying cheap insurance. We want time on our side, right? Remember, the same strike, you compare a 30-day or 45-day out option to something 6 months out in time, it's not going to be 6 times the cost. You're paying less per day. Even though you're paying more up front, you're paying less per day. And we don't want to be spending into the highest time value. That is the proper structure. Okay? But now you know, but we do the heavy lifting for you. Rather than showing you what I did on Tuesday, and of course when I did that, I posted also that to the Fusion subscribers. That was an actual trade that Fusion subscribers saw and could follow if they wanted to. But let's go to PowerOptions now. Let's take a look at the married put screen for radioactive trades, and let's look at some live examples of the puts that I would likely select if I was opening a new position today. Which, depending on what comes up, might actually do that. All right, so here we are at a trial account to PowerOptions. Have my available tools up here. We're going to go into the married put tool, and I'm going to go into search. Here we see, let's scroll down below the listed trades, but here we see the default search, radioactive, sorted by maximum risk. We already put in what we look for when opening a new radioactive trade. This is the exact starting point that Ernie and myself use when we're opening a new position. What are we doing? We're forcing the options to be at least 150 days out in time. We're putting that risk into that 4 to 8%, 3.5 to 9% range, and we don't want to go more than 20% in the money because we don't want to hedge ourselves out of the position. Yeah, I want to control the bid-ask spread a little bit. I don't want to trade something that has zero open interest. All right, so we're putting some basic filters in there for liquidity. The farther out options are going to be traded less, but this is already there. And then we've put in the technicals, fundamentals, and stock lists that have worked for us since Ernie and I began trading this technique back in 2008. I trade this with about 50% of my portfolio. 50% of it is allocated to the radioactive trading techniques. And this is the same search criteria that I've been using since about 2007, 2008, all the way through the crash and beyond. Now, let's take a look at the results that came up just on this default screen. Our first one is an interesting one, PBF Energy. Stock's at 52.82, down 63 cents. A lot of things are down today. I could buy the March 60 put for $9.60. Okay, so it's a debit of 62.42 on a stock trading at 52.82, and the risk is a little bit on the low side, isn't it? It's at 3.9%. Now the next thing I would do is I'd go over here and I'd take a look at PBF Energy. I don't know this stock. I can kind of guess what it does, but I'm going to look at the chart. I'm going to make sure it's a stock I feel has a good trend and good performance and is not overly volatile for a radioactive position, for a long-term married put position. I'll then, of course, take a look at some other information, the company info, news, and profile. But one of the things I did with Penn, when I ran the search and Penn came up on Tuesday, I went to the search by symbol. Now, if I decide I like this stock, I like the chart, I don't see anything in the news or the headlines that might cause me hesitation to enter this position. Maybe it pays a dividend. Yeah, it does, 2.3%. That's pretty good. It got a good earnings per share growth, 88%. It's pretty high. So now what I'm going to do is I'm going to actually take a look at search by symbol. I know that this is the stock I want. I see that this risk is available. It's out to March, 162 days. That's still within my range. But just as I did with Penn, I want to take a look at those other strikes. What other strikes are available with stock trading at 52.82? 60 strikes, about 7 points in the money. It's kind of a steep move to expect, but again, looking at the stock chart would tell me if that's a reasonable expectation in the next 20 to 30 days. So what do I know? I know that this is too deep in the money. And I don't want to go to the 50. That's a risk of 11.1%, 11.7%. Here I'm in that double digits. Don't want it. Even though it's cheaper, remember, cheaper, you get what you pay for. So I'm going to focus on the three bears. And where are my three bears? Well, they're right here. Oops, sorry. 2.1%, a little bit low. 3.9 and 7%. So I want to check to make sure the 65 is really the one. I'm sorry, the 60 is really the one that I want. Good controlled risk, 3.9%. The stock pays a 2.3% dividend. If I do like the stock, but I think it's a slower mover, even with a risk at 7%, to be honest, I'm going to be tempted to go with the 55. This stock rebounds back up. Today's a down day for most stocks. If PBF goes back up, 53.40 moves up to 54, I'm going to be able to start generating premium against this one faster than the 60. Won't do me any good to sell a 55 call or do one of our riskless spread trades, the bear call spread or the ratio call spread, if I have the 60 put and the stock's only at 54. I don't want to sell the 55 call. That's going to increase my risk. I'm going to show an example of that in a minute. The 60 is a good risk, But to tell you the truth, I might be leaning more towards the 55 in this case, depending on my outlook from the stock chart. Okay. Let's take another example real quick. We see a couple wing stops in here, and there's a couple. Penn is right there too. Penn is already in here, and it's showing the 35 with a 6.6% risk, a little bit higher than what I was able to get in the other day. I want you to notice something too, by the way. Remember, let's just look at Penn real quick. I'm going to look at the profit and loss chart for Penn. The stock, folks. The stock today is at 33.37. Midpoint for that April 35 put is $4. What did I get it at on Tuesday? Bought the stock at 33. Bought that same April 35 put for $4.20. So in this case, around midpoint, what are we looking at? I've lost 20 cents on the put. I've gained 37 cents on the stock. I didn't need the stock to go to 37.20 at my cost basis. I'm at a small profit right now on the position. Again, I'm just illustrating the put does not go to zero. As the stock moves up, you're still gaining positive delta with this proper structure. And right now, even though the stock is not at 37.20, my technical break even, if you just look at the price, I'm at a profit. I'm only losing about 50 cents for every dollar the stock moves, and that'll go lower and lower as the stock continues to move up. The first day after I entered the trade, as I mentioned, Penn went up to about 34.20, 34.30, somewhere in that range. My put was still worth $3.95, $3.80. It didn't go to zero. I could still use that put as manipulation to get some of that time value back and maybe adjust the strike, move it in time. There's 4 different income methods that involve adjusting or moving the put to lower the risk on the position or lower the cost basis. So to tell you the truth, if I was opening Penn today, I'd probably use this same strike and this same structure. I wouldn't use the 34, wouldn't use the 36. I'd probably still be right here at the 35. All right, but let's take a look at Wingstop. This one looks too deep in the money to me. That risk is too low. The reason why is because I'm sorting this by percentage risk lowest to highest. There's probably a better strike, and I see one down here. Here the 70 is at 6.7%. Lower risk at 4.3, that looks pretty good. It's about 9 points in the money. If there's a 72.5 strike in there, that might look really good too. But once again, it's a reasonable trade. Both of them are reasonable married puts. But once I look at that stock chart, gauge my expectation of the movement going forward, click on that search by symbol tool, I'll see all the available positions. Fortunately, Wingstop doesn't have a 72.5 strike. Here I don't have 3 bears, to be honest with you. That 80 is too deep in the money. It has a risk of 2.5%, but that's too deep in the money. The 65 is out of the money, and there we are again. Double-digit risk. Don't want it. Doesn't put the market odds in my favor if I do allow myself to take that 10, 11, 14% risk, even though it's cheaper. So my focus is going to be right on these two, the 75 and the 70. Both are reasonable married puts. Depends on your risk tolerance. I'm probably likely to go in this range with the 70, closer to the stock price, a little bit higher risk. But if you're more conservative, there's nothing wrong here. But you don't really want to go deeper than that. Hey, the 85 only gives you a risk of 1.3%, doesn't it? Well, in order to be able to do a proper adjustment, it's only $1.14 risk, 1.3%. But in order to do a proper adjustment, I have to wait for the stock to go up to 83 or 84. Tell you what, if I entered the 70 or the 75 and the stock did go up to 83 or 84, I'm at a much higher profit than I am with either of these two positions. Okay? But I promised an example of that. Let's take that low risk. Let's take that deep in the money 85 strike, only a risk of $1.14. I should be able to make that $1.14 up very quickly. Well, this is why the blueprint is important, because it discusses not only what the 12 different income methods are, but how not to use them. It's pretty expensive too, so I could buy stock at 66, 65. I could buy a March 85 put for around 1930 at midpoint, I've got a risk at midpoint of only $94, 1.1%. I should be able to make up 94 cents right now, even with October only 17 days away. Let's take a look. All right, so 15 days to October expiration. What do I need? Well, I need 94 cents, so I can't use the 70 call there. It's only at 35 to 55. Let's push it out to November. I bet you we can get $1 there. Yep, absolutely. I can sell the 75 call and make up that position right now, make up that premium right now, and have a no-risk trade, right? Let's sell that 75 call. Force an income method early. We'll take the midpoint price there of about $1.20. So I had a 94-cent risk, sold it for $1.20. I'm guaranteed 30 cents profit. I have a no-risk trade, right? Wrong. Got to think of the structure. I bought the stock at 66. I bought an 85 put for 1930, which pushed my cost basis up to about 85.95. I now sold a November 75 call. Still pretty far out of the money. But what happens if my expectations are exceeded? Something happens with Wing, and probably between now and November, we probably have earnings coming out. They haven't happened recently. Let's say the stock does go up to 78, 79 by November expiration. What's happening? How's my risk up to 11.5%? And it's because you agreed to potentially give up your shares of stock at 75 on a total investment into the position at 84.75. So the married put structure by itself, you still have positive delta. If you try to force an income method too soon, try to do it incorrectly, yes, you have a no-risk trade to the downside. That is true. But you've doubled your risk to the upside, because once it crosses 75, you no longer have positive delta on the stock. As it continues up, any gain you have on the stock is countered by that 75 call below the put strike price. That's a no-no. Don't want to sell the call below the put strike price, because it puts you in a position where if the stock does what you want, you can actually have higher losses than you originally anticipated. So this is the wrong put. And trying to force an income method too soon is the wrong approach. That's what we talk about in the blueprint, the when and the how to properly set up the structure as we showed today. But at the same time, the proper way to use the income methods so you don't get in trouble. Now, you can watch a few of these webinars. You can go out and say, hey, I think I know what I want to do. Mike showed me how to open this trade. What makes sense to me? I'll sell a call now and do that. Hey, it's income method number one. But if you do it incorrectly, you can find yourself capping your gains too soon and increasing your risk if you're right on the direction of the stock or some really good news comes out. That's not the proper approach. I'd wait for the stock to go here. But if I started off properly with the 70 put, or maybe the 75 for this particular position, controlled risk properly, if the stock goes up to $68, $69, I'm in a great position to what? Sell premium where? At the money for the highest time value, or even slightly out of the money for reasonable time premium. And I won't have that position where I can lose to the upside. If you buy the put too deep in and think, hey, this is a great low risk, I'm sure there's $1 premium I can get somewhere out there, you've actually created a bearish position on a stock you just researched and analyzed to be bullish on. You're trading against yourself. That's not the proper way to limit risk, or the proper way to put the market odds in your favor. Tim asked a question, and he says, what can I do if I already have a stock? Okay, well, in PowerOptions, we've got a great tool for that too. Under the married put, or even in the signature tools, we have what's called the insurance tool. So let's say Goose is a married put that I'm in. I got into it around 36. I think it's around 65 today. Took a big hit today, as did Ollie. But let's just say I own Goose, and I happen to get into the position at around $55 per share. Now, what this tool will do is show us what puts are available and what my new risk would be based on my lower cost basis. Let's take a look. Okay, so Goose is only at 55.34. It took a bigger hit today. Let's do 50. I'm sorry, let's do 50. and was there recently. Okay, so now I have an unrealized 10% gain in the position. Now what did we learn today? What did we talk about? I could buy a cheap October put. Right? I could pay less money for only 22 days out. What does this locked-in profit mean? That means that these puts here, the 57.5, the 57 strike, 56.50, even the 56 at 275, that puts my cost basis up to 52.75. So although I'm not taking the 10.7% gain, I'm guaranteeing 6.2% profit. It's a bulletproof trade. The worst I can do in 22 days is make 6.2%, but if the stock continues up, I'm going to have a higher profit. But I think why you're asking me this question is because you have a stock with a lower cost basis. You have a good run up until the last 2 days or so, and you want to know what can I do to ensure the position. But how long are you planning on staying in the position? What did we learn today? It's not cost effective to buy. It's cheaper, and you can lock in a higher gain, but you're not planning on exiting in October. If you're planning on exiting in 22 days, you might as well just liquidate now and take the 10% gain in this example. Rather than pay more money, lock in 6.2. We want to go further out in time. I want to go maybe to January, maybe to April, what's available. So let's just go to January, about 106 days out, I believe. Still a good reasonable time. You're probably staying in it for an extended period. With the stock trading right at about 55.35, not too great. It's kind of expensive, but I can have a bulletproof trade for the next 3.5 months. No risk going in, and I could still do different adjustments. Let's take a look at that. Let's go to the profit and loss chart here. So here we show a negative risk. What does that mean? Positive gain. Worst case scenario between now and January, even if the market collapses, I'm going to make 1.6%. Why did I choose the 60 put? Because just like opening a new married put position, I don't want to go to the 70 or the 75. Does lock in a higher profit, but I can't really do anything else unless the stock really climbs up to $68 or $69. I want to go maybe 1, 2 strikes in the money in this case, give me a nice locked-in profit, and I can, if my expectation is it's going to continue to grow and I'm going to hold it for a few months, I have a no-risk trade. Can't lose on this position. And if the stock recovers back up to 57 or 58, where it was 2 days ago, it was up to 65, I think, a few days ago, before the pullback, then I can do other adjustments and increase this guaranteed profit and increase my upside return as well. Okay? Coffee, this is a question came in from Coffee. It says, with your tool, how can we search for debit spread where both calls are in the money? I'll send you an email about that. I'm not going to go into, you can do it, all right? You can set the strike difference you want. You can set the range in or out of the money for the short option in the bull call debit spread search. It's very simple. I'll send you an email after the presentation. We're going to focus here on the married puts and radioactive trades without going into other strategies. And of course, I might cover that Friday in our open discussion that we host at 4:30 every Friday afternoon. I might throw in that there so you have a video copy of that as well. Okay, but going back to where we were, if you do have an unrealized gain and you're worried now about the pullback in the market and you think, oh, well, my stock was as high as 62 recently, but everything is pulled back today, I think I should maybe just sell a call right now at 57.50 to generate $1 premium on Goose, and that'll give me some protection. Well, if it continues down, you've only gained $1. If it recovers and 3 days from now, it's back up to 62 or 63, you've now got to pay $4 or $5 to roll that 57.5 call. Better to just go out in time on a position you want to stay in. You still have an unrealized gain. Put some money in, not a lot, but put some money in to guarantee a profit on the position and leave the upside open. And if it continues down, you've still got a locked-in profit. If you just sell a call, you maybe hedge it by $1 or so, but if it falls another 4 points, you're still down 3. Here, you're locked in. Of course, by the way, I could choose to sell an October call This tool will allow you to do that. What would those look like? Let's just see what we've got here. Okay, so it doesn't like any of those combinations, and the reason why is because it can't find a good premium for October. Let's go to November. I bet you that'll work. There we go. Okay, so I could buy the January 60 put and sell the November 60 call for $2.95. So that locked-in profit is now 6.5%, and we still have potential further upside on the position as well. Okay? So this can do both. But to begin with, if you're worried about what we're seeing today, if you're worried about it might continue, rather than just sell a call in the stock you have an unrealized gain in, check out that insurance tool at PowerOptions, see what puts you could buy. They could put you in a proper structure with controlled risk, with potentially a bulletproof status as well, and then you can do adjustments going forward. All right, so we've covered what strike price we would look for. Let's just review very quickly. When I open a new married put, I don't want to buy a short-term cheap put cost that takes that higher risk. I want to buy further out in time, minimum of at least 5 months out in time. It's okay to buy a year out in time too, if the risk matches your threshold, your goals for the position. So we want to avoid the rapid time decay that we see with those cheap near-term puts. Going slightly in the money, 1 or 2 strikes. We showed how that's the proper controlled risk of 4 to 8% without hedging myself out of the position or without taking the double-digit risks, which doesn't put the market odds in my favor. I want the right risk, put time on our side, and I don't want to be paying at the money for the highest time premium. So what's the next step for you going forward? Well, of course, we're recording today's presentation. We're going to post it this afternoon. We'll send you an email. Feel free to watch the archive, go back through the presentation. If you haven't yet, go over to RadioActiveTrading.com, just put in your name and email and click the button to get the sketch. It's a free white paper, 9 pages long, that talks a little bit more about the benefits of the initial structure and a little deeper look into that income method number 1 I just showed you today. And of course, if you're interested in taking a look at the search where we do that heavy lifting for you, or the insurance tool to try to help you lock in some of the gains you might have, the unrealized gains on stocks that you're holding, a little bit fearful of this market dropping the past couple of days and today's little movement down in the market, go to PowerOp.com. You just put in your name and email. You can take a 14-day free trial, go to the Married Put tab, run the search, click on that insurance tool, put in your stock and your cost basis, and see which puts you could buy right now that might be able to lock in most of your unrealized profit while still having 2, 3, 4 months of insurance going forward, and still the ability to have unlimited upside if everything recovers. Okay? No, Cameron, great question. Let me pause the screen for a moment. Let me pause the screen here and scroll back a few slides to one of our married put profit and loss charts. There we go. Actually, Cameron, I'm going to go back to PowerOptions for a moment. That's okay, but I'm going to take your question right now. Let's go back to PowerOptions. I'm going to go right back to the goose trade that we were looking at. Actually, my goose trade on the profit and loss chart. Not goose, I'm sorry, pen. Look at the pen trade I opened yesterday. Okay, sorry, folks. There we go. So here's the position I opened for Fusion subscribers. And here, of course, is the risk 220 worst case scenario, 5.9%. And Cameron says, Mike, we have to exercise for the guaranteed profit if the stock drops drastically. Is that right? Not really. Now, recently, I usually don't hold one of these radioactive trades all the way to expiration. Why? Remember the time value decay. When I get to that last 30 to 40 days of the trade, I'm going to start seeing whatever time value I still have left in whatever put I'm holding, if I haven't adjusted it, start to decay. So I probably would close it 45 to 60 days before expiration in most cases. I'm holding 2 right now that I've held almost to October expiration because I'm just milking them for a little bit of extra profit. There was a trade, Interactive Brokers, where I exercised the put for small loss I held it to September expiration. I let it be exercised. I can't remember the strike, but I let it be exercised for a small loss of, I think, about 1.4%. The stock was down 12% from when I got in. So close the position. I held that all the way to expiration simply because the market maker wasn't giving me the right price. The midpoint price for the put between his bid and ask strikes, the put that I was holding, was below intrinsic value. I'm not letting that go for below intrinsic value. Okay? So I held it, and then it automatically exercised and closed out my stock. I didn't have to do anything. I was out of Interactive Brokers at 80, where my put was, with the stock, I believe, trading at 59.20. But the market maker wasn't giving me fair value, so I just held it for an extra 15 to 20 days and then let it close out. Now, all that being said, you have to exercise if it drops drastically. I'd usually close it before I'm out of time value on the position. But what is drastic? Let's say the stock drops to $20 per share. Okay, a very significant 13-point drop for whatever reason. Let's say it happens in the next month. Happens by November 5th. Stock drops to 20. What do I know? Well, my put's going to be worth about $15. And here it shows the expected value of 15 if implied volatility stays where it is. Okay? Do I have to exercise it? No. A lot of times this might be actually at 15.10, 15.20, 15.40. Why? Even though it fell drastically, I still have 5 months to expiration. There's going to be some time value even though it's very deep in the money. Maybe not much. So Cameron, in that case, what I do instead of exercising it, I'd sell to close, let's say 15.40, sell to close the stock at 20, I get 35.40 back. There's still time value remaining. I want to take advantage of that time value. Okay? Now, a less significant drop, still significant. Let's say it drops down to 28. Now let's go 6 points. Let's go 20%. Let's say it drops down to 27 on November 5th. We'll see here, this put would be worth 8. This is just the Black-Scholes pricing model. It shows this would be at 8.12. I don't want to exercise and only get 35 back. Sell to close the stock, sell to close the put, 35.12. Not a lot here, but I still get that extra time value back that I paid into. Not at the full loss yet. Okay. If it just dropped 10%, let's say to 29.70 roughly, okay, so it drops 10% from my $33 entry price. 35 here, yes, it's 602. That's not realistic, by the way. I don't like how that Black-Scholes, oh no, that is good. I'm sorry, that's fine, 602. Okay, well, 29.70. My put is $5.30 in the money. There's still 70 cents of time premium left, even though it's deep in the money, when the stock's dropped about 10%. I'm selling to close this and selling to close this here, so my liquidation would be 35.72. If I just exercise, I only get 35 back. I'm missing that other 72 cents. So depending on the time frame. Now, you're right, Cameron. If the stock fell to, again, $20, $25, let's say, and it was in March. I'd held this position to March. Maybe I made some adjustments. Maybe I didn't. But in this case, there's not going to be much time value left. That's decaying rapidly. I could call my broker to exercise it, but most likely I'll just sell to close the put and sell to close the stock. I'll liquidate the entire position to get back any time value if there's any that still remains in that situation. Okay. This worst case scenario is if I held it all the way to expiration, made no adjustments, and the stock remained below $35, my put strike price. And if I did nothing Friday at 4 o'clock on expiration day in April, the stock was at 33, yes, my broker would exercise automatically the put for 35. I get 35 back minus whatever transaction fees. I'm at the max risk of 5.9%. But again, 45 days to 60 days before expiration, if I've met my goals for the position, I don't have an earnings code. This is all talked about in the blueprint. There's a whole chapter on exiting the RPMs and the when and if scenarios. But because the time value decay, I don't want whatever I have left to rapidly decay. 45 to 60 days before expiration, I'm likely selling to close that position. Selling to close the put and selling to close the stock. Or using one of the income methods to move the put further out in time. Okay? To continue the trade if I still have a bullish outlook on the position going forward. That's what's in the blueprint, the when and the hows to make the adjustments, do the different techniques, how not to use the different techniques to get you into trouble, when we should consider liquidating, when we should consider adjusting. That's all described for you there in the blueprint. Okay, but yes, Cameron, most likely I will look for a way to liquidate the position entirely and liquidate the put rather than go through and simply exercise the put. All right, so review again. I'll get this posted for you this afternoon. Feel free to review the archive webinar. If you haven't, go to RadioActiveTrading.com and get the free white paper, the sketch. If you want to take a look at that insurance tool, or you want to look at the married put search for potential new protected positions that Ernie and I would likely open in our account today if we were opening a new position, just go to PowerOp.com, put in your name and email address, and you can start a 14-day free trial. You have access to all the tools for 14 days, no credit card needed. The next step, of course, if you want to see the 12 income methods, the only place where we discuss all 12 income methods, the proper structure in depth, is the blueprint. You can go to RadioActiveTrading.com/Iridium to see the current bonuses we're running right now. The blueprint is a 230 page text contained in a 3-ring binder, physical product. It's $339, but if you pick up the blueprint, you'll get the quick action guide to help you get started more quickly. We'll send you the first of the Mastery Series videos for free. There's 6 Mastery Series videos, 7 coming soon, but there's 6 Mastery Series. We'll include that first one for free. You can get that first month of Fusion I mentioned, where you can follow my trades, Ernie's trades, and Greg's trades, and also have access to members-only webinars further discussing the different techniques for only $10. It's usually $69 there. And instead of a 14-day free trial, you get a free month of PowerOptions as well. So you go to RadioActiveTrading.com/Iridium, check out the information in the blueprint. Now, I mentioned next week I'm going to send you all an email. We're going to talk about the role of the income methods. We already showed a little bit of one today, but I'm going to show you the role of the income methods. You'll receive an email, and that's coming up next week. But the only place where I'm ever going to go through all 12 of the different income methods, when and how not to use them, how to use them, combine them in conjunction with one another to increase returns or more, is in the blueprint. So check it out. Go to RadioActiveTrading.com/Iridium, see the bonus offers. In addition to that, it is a no-risk venture. Talk about bulletproof trades and no-risk trades. If you pick up the blueprint, it comes with a money-back guarantee. When you receive it, you open it up, you start going through a few chapters, but you feel it's not what you want, you don't see how it's going to fit in your portfolio, no problem. Send it back to us, we'll refund your purchase price. As I mentioned, you also have access to members-only webinars. There's Fusion members-only webinars, and there's an overlap, but there's also Blueprint members-only webinars as well. And you'll get live introductions to those also, live invitations to the live webinars, and access to the archives if you pick up the blueprint. Thursday I said 12 noon, it's the 12 different income methods. It's not the 12 different income methods. For Blueprint members only and Fusion members only, probably Thursday at 12 noon, we're going to discuss the 5 or 6 ways to manage income method number 6, one of the 12 income methods. So that'll probably be next Thursday, at 12 noon Eastern Time. Those of you who are Blueprint owners, you'll receive an email for that also. Well, I want to thank you for joining me today. I hope you got some useful information on how to properly structure a married put trade. How it's better, the radioactive approach is much better than the standard way you've probably seen taught for free at your broker or free white paper or Investopedia or things of that nature. Put time on your side. Control your risk to that single digits. Don't hedge yourself out by buying too deep in the money, and don't go cheap. Of course, if you do have any questions, you can always email me, support@radioactivetrading.com. You can also call us at market hours at 302-992-7971. You'll also receive an email soon about the archive being posted and where you can access the recording of today's presentation. I'll also send you an invite to next Tuesday's webinar on the role of the income methods. Ladies and gentlemen, have a great trading day. Have a fantastic remainder of your week, and we'll see you soon. Good night.